may notice that one of the biggest events in Washington, D.C. every spring is the annual USDA Ag Outlook meeting, and we have patterned this event as kind of a precursor to the big one that will be held, we hear, in person in 2023, so we're excited about that. Dr. Seth Meyer will be our lead presenter, and when he's done, I'll call on our other panelists, and then we should have some more time for Q&A. Seth Meyer is the chief economist for USDA. He was appointed to that position in January of 2020, just right on time for the pandemic. I know there was no relationship, but a difficult time to start everyone working remotely. He came back to USDA for this position after 2 years. He had been working out in Missouri for the Food and Agricultural Policy Research Institute, and I know you've got some comrades here from FAPRI, University of Missouri. Prior to a stint at FAPRI, Dr. Meyer was head of the World Agricultural Outlook Board. He's previously worked at the Food and Agricultural Organization of the United Nations, and also has served on several research institutions. He's a native of Southeast Iowa with degrees from Iowa State University, go Cyclones, and the University of Missouri. So please welcome Seth Meyer.
All right, thank you all. I'm going to wander around on the stage, I hope that's okay. It makes me feel more comfortable, but I want to thank the organizers for inviting me. First of all, I always love to be back in the Midwest. That's first of all. And the second thing I want to thank them for is to putting me in front of the rest of the panelists who are experts, and so I can say a few things and not the leftover scraps, because they will provide you with a lot of great information. So I will try to keep this succinct as I talk. And then finally, while the Office of the Chief Economist has some pretty wide-ranging responsibilities, one of my favorite things to talk about is agricultural markets. But really over the last couple of years, ag markets have really fueled my procrastination tendencies, right? If you produce a presentation too far out, there's a good chance it'll be worthless the last couple of years as you go to present it. So I thought I'd do something a little bit different. What I've been doing lately is I'm going to show you all the stuff that I show internally at USDA, the things that are on my mind, the things that we send to the White House about various activities going on in U.S. agriculture, and I'll try to talk to you about the dynamics. And then when you want all the real facts and insider information, I've got the panelists to back me up, all right? So let's get started here. And so one of the first things, and I've got to do this myself, all right. So one of the first things, I talk a lot about this. When one looks at farm income and one looks at it at a very high scale, farm income looks pretty good. We're forecasting farm income to be pretty strong at USDA. But I think underlying this, and I'm showing you this first and not last, because I think there are a tremendous amount of questions that go along with this. For me, very positive in aggregate, but different outcomes for different crops. A lot of anxiety being produced when you think about where do commodity prices go from here and where do input prices go from here. So you're experiencing producers experiencing not only volatility on the output side, but on the input side as well too. And I'm sure Nate will provide us some additional information on the status of the ag economy. But this is something we look at here. And when you tell producers this, you always got to realize that there's a tremendous amount of anxiety. Those input prices are catching up to them, and output prices, where are they headed? So let's dig in a little bit. I also remind folks, I show them this graph and I update it often because I can tell lots of stories from this single graph. And I go back and I remind folks, it isn't war in Ukraine that really sparked all this run up in prices. They've been rising since about fall of 2020. And a big element of that, one easy thing to identify, is China coming back into our market. And that really has been a demand story. We've had pretty good global demand over this period. And I'll come back to that at the end. But we've had pretty good global demand. And you can see in here also issues of things we are used to in agriculture, like short crops, the vagaries of weather. But you can also see in here other things like war in Ukraine that are completely man-made and yet are having large impacts on the agricultural sector. And so while prices have come down pretty substantially from those wartime highs, they remain pretty elevated. Okay. So again, I'm going to bounce around to a lot of different topics over this, try and push this into 20 minutes, but I'm going to show you a whole bunch of stuff here, which is, you start to see, though, what's this other element? What is producing some of this anxiety? And some of what's producing this anxiety, and you can see things like rental rates starting to increase. You can see very strong growth in land prices and rental rates over the last couple years. And rental rates may be a one-off, one-year decision, but land prices certainly aren't. And so folks are making decisions, and we're seeing increases in land costs in a pretty volatile time. So you can see some, and this is just last year. I'm an Iowan, like Sara told you, 10% increase year over year. Those are big increases. But again, let's talk a little bit. Now I'm going to kind of go back and we'll talk through the situation we find ourselves in. And again, one of the elements so far in the last, say, 18 to 24 months has been that element of demand. China coming back into our market, they got as low as number 5 when we had trade friction with them. They have come back strongly. I see that there's 2 ways to read this chart. The one I just told you is China, and the other way to read this chart is, despite what we've had much higher prices, we've continued to see our partners from Canada and Mexico remain in the market. Okay, so demand has been pretty good. So the obvious thing to read into this is, well, China's come back in strong. Well, the other way to read that is, and not everybody's backed out and made room for the Chinese, so that's been an element, demand. But again, on the other side of that has been all those input costs. So this is from the latest farm income report out of ERS. I've got some ERS colleagues in the room. This slide usually has a line in it somewhere in the middle and a black line that runs through the center, and it says everything above the black line, inputs increased in price. Everything below the black line, inputs decreased in price. There's no black line this year. Every single one of these inputs has shown pretty big year-over-year increases. And we talk a lot about, at USDA, about, for this crop that you're coming in to harvest, some folks might have either been lucky or good, and it doesn't matter which really, in purchasing those inputs for the crop that they're harvesting now, a little bit ahead of the big price run-up. You don't have that same opportunity now. Fertilizer prices are high. They're off the peak in the spot market, but they are certainly higher than they have been. So historically, and so you look through this and every one of those inputs has shown increases year over year. And again, a source of anxiety when you have both high volatility on both sides of your budget. So here, and it isn't, so you can see this relative volatility in terms of fertilizer price index. That's the light blue line. Corn and soybeans and energy. And you can see some of this big spikes related to war in Ukraine, but not all of it, right? And so we've got a link in the global market between energy, what's going on with Russia and Ukraine, what's going on in Europe, what's going on in the US, and all of these fertilizer markets being somewhat interconnected, and corn and soybeans also as a part of this. And again, prices have come down from those wartime highs, but remain elevated. And what we're also seeing is, so one of my jobs, when the first time I worked at USDA was I ran the World Agricultural Outlook Board. So it is the global look at supply and demand balances, okay? One of the critical things that I look at when I look at global supply and demand balances, for most commodities, the marketing year which has just started, we will end this marketing year tighter for many stocks than we began. Right? So we think we're tight now. Well, the market's looking forward and saying, at least for this coming marketing year, these markets are going to remain tight. Now, soybeans at a global level, we might expand stocks, but not in the United States. We've had tremendous demand for soybean and soybean crush in the United States. So when I look at this, first of all, take out China. Stocks are, we don't know what the stocks in China are. We'll put out a number, but it's incredibly uncertain. But you look at this and you say, we're tightening up these markets around the world. And another way to look at this is a forward curve for futures markets. So it's the nearby, and then it says, okay, a little bit farther out in the futures market, a little bit farther out in the futures market, and says, where does the market think we are headed? And you can see that red line there for pre-war levels. You can see in the immediate aftermath of the war, everybody's struggling with how long is this going to last? And then you get back to the point where folks say, okay, this is going to be a problem, markets are tighter, and it's going to linger, all right? And so you can look at these forward curves and you could say, compared to a year ago, it's still pretty flat, but at a much higher level, and folks think, okay, in the immediate aftermath of the war, is this going to go away? Well, this is maybe it's going to be around for a while, folks think. One of the other things we have struggled mightily with is Ukraine. So initially we start out looking at where all the grain silos are. Where is the fighting? The ports were closed. Then we get a grain deal, and those 3 ports that I've circled in the bottom open up. Now the problem is, before the grain deal, the Ukrainians, we go back to pre-war, the Ukrainians could ship 5 to 7 million metric tons of grain a month. When the war starts, they were lucky to get out 2 million metric tons a month. Even with the grain deal, maybe they can do 3 million metric tons a month. Okay, so there's a real problem here where the ability to ship grain is maybe constrained to half of the export volume it was before. The Ukrainians did a Herculean effort getting that crop planted. They're going to have to do a Herculean effort to get it harvested, and yet they will still have storage problems going forward. On top of that, those red lines there was the conflict area 10 days ago. Okay, so we went from I was not updating those because the battlefield was pretty static. It's become very dynamic all of a sudden. Okay, and so this continues to overhang the market, and the Ukrainians themselves will have to rationalize their production in terms of what their output and contribution to the global market will be, unless there is an ability to ship more grain. So another thing that's always on the mind of folks in the U.S. government is, hey, we don't have sanctions on food or fertilizer, and Putin talks about the grain deal not working for him. Well, what does that mean? Well, one of the ways to get at this is if Putin says, well, the wheat is going the wrong places, or he says, hey, my wheat's not moving. Well, let's look at the prices for these various outputs of wheat as a way to look at this. And in fact, when the war occurred, Russian prices for wheat dropped. Sanctions were quick moving. Now that we've made it clear that those sanctions are not on food and fertilizer, we've seen the Russian value of wheat return to its more normal level. It's still a little bit of discount. Does that make sense? Yeah, they've got a record large crop. Okay, so Russians got a record large crop. It might still be at a discount, but spend a lot of time explaining to people when they are concerned about, are the sanctions having an effect? Let's look at FOB prices, and what do prices tell us in this event? And what it tells me is, it isn't clear that this isn't a problem. Russia's slow start on wheat exports, maybe it's an internal problem with their ability to ship, because the FOB prices don't suggest significantly otherwise. Again, high amount of volatility here, though. We've got record high volatility. This is like another, we're looking at futures contracts, options contracts here to talk about volatility, price swings, uncertainty. You could call this an anxiety index on your output prices, right? You got tremendous amount of volatility in wheat, which makes sense because it's one of the biggest products from the Black Sea, but you also have a tremendous amount of volatility in corn markets, being brought along with it. Same curve, futures forward-looking curve from last week for corn. So you can see Ukraine being a big exporter of corn, a relatively big exporter of corn, and the market continuously looking for the next harvest, whether that be in North America or whether that be in South America, in order to cool this market. And it's saying, okay, this is the direction of head in prices. Prices are likely to cool even with risk. So again, keep putting in your mind, you're buying fertilizer today. What's the path of prices going forward? Let's talk really quick about the crop in the United States as well, too, because one of the things we saw a little rally after the latest USDA report. I would argue that wasn't a yield issue. Yields had steadily declined because conditions weren't so great for corn and beans, a little below trend, not terrible. That wasn't the surprise. Yield was not the surprise in the marketplace, but production was because of area. Okay, so now we've gone in and we've moved this instability or this tighter markets a little further down the road because now we've shrunk the size of the U.S. crop a little further. It's more certain. I think we're a little farther along, but it also means we've pushed that uncertainty of tight markets a little further out in time. Okay. And here also, we continue to have tight global stock numbers for lots of commodities. And again, exporting countries here, excluding China, because we don't really have great information on their stocks, continuing to say at a global level, markets will be tight. Okay. But there's also a lot of other things going on in the market here. So I'm going to try and talk a lot about several different things with this slide, but do it quickly. So Indonesian palm oil here. So we saw a big run up in vegetable oils, but I'm specifically picking palm here for one reason, which is export controls are bad. So I want to make sure that I put that out there. So we had a run in vegetable oil prices. The Indonesians decided to put export controls on, which supported palm a little bit more. And then they had to take them off. And that's why you see a bit of a dip there. So part of this is to show export controls are bad, and part of it's to say we've had some strength in vegetable oils. And then on the right side, there's a little bit more going on as well too. So blue is Argentina, and red is the United States, and this is soybean oil relative to palm. And one of the things that's important to note is we've had pretty good strength in soybean oil prices in the United States. Crush has been very strong. Oil has been a bigger part of the bean value, and that has really, that we have more crush coming online, but that's been a big element domestically. Part of that, renewable biodiesel. Part of that is renewable diesel, okay? So we have seen some strength in the domestic market, and although at a global level we are likely to build stocks in soybeans, because of crush strength in the United States, we'll probably end up with lower stocks in the United States. Okay, so again, some important dynamics going on in the soybean market. Let's talk about cattle real quick as well too, because we got some USMEF here to talk more detail, which is we're also in a contraction phase in the cattle cycle. These are also things we talk about at USDA. Where is the bottom of this cattle cycle? Right now, if one looks at heifer retention or heifer slaughter, decisions made today aren't a stake until late 2025. And right now, it doesn't look like folks are holding back those animals necessary to expand this. So we will continue to see contraction in slaughter numbers, most likely, out into that period. At the same period, folks are thinking, do we need to build additional capacity, or what do packer margins look like? Okay, so this is an important economic question here. I think we'll find out a lot about the dynamics of the cattle market in the next 18 to 24 months when this balance between cattle numbers and slaughter capacity meet. We'll learn a lot that's been maybe different than the last 5 years. Okay, so let's go back to trade again. This is just an aggregation of that country one that I showed you before, which really says, hey, you know, we've got record export volumes, and while we're forecasting them down a little bit next year, I'll point out a couple things. One, it's really early, and there's a lot of uncertainty surrounding that. And then the next thing I'll point out is some of the things I think that we're showing declines in export value. If we had more of them, we could sell them more. Sorghum, we had some sorghum folks here. Beef, if we had more beef, we probably could have sold it. So again, demand has been a big contributor to this, and part of my concern is where does global demand go as we look forward and the Fed raises interest rates here and other folks are forced to follow suit. Okay, so let's talk just a couple more slides. I only got a couple more for you on food price inflation. So ag commodity PPI here. So this is commodity prices. Always show a tremendous amount of volatility. That doesn't mean, we talk about at the farm gate, 16 cents of the food dollar is before the farm gate. 16 cents on average. A little more for meat, a little less for grains, but there is a lot of costs after the farm gate. And that's why when you see commodity price volatility, it doesn't necessarily translate into retail food price volatility, right? It's very modest increases. But what you are seeing is, in food price inflation, is the fact that started in meat has actually cooled. It broadened across a whole sector of goods, and it has increased in terms of rates. Okay, now the question is base effects will start to, we're moving through time, and will the rate, have we peaked in food price inflation or not? But we continue to see disruptions in supply chains. We avoided a big one when it came to the rail strike, and we continue to see that food price inflation is an element of what is affecting people's purchasing decisions. Here's food expenditures across a large number of categories. So folks are having to make decisions about what goods they're purchasing. Now, I think the beef folks will be happy, which is it's the one where the expenditures haven't fallen, right? And so folks, they are seeing an element of demand. But again, one of the things I think here, we talked about the uncertainty of input and output prices, and then aggregate demand going forward is the other big part of this question. So this is my last one, which kind of talks about this period of good farm income versus interest rates, and kind of what happens to farm income. I'm not saying causally, but look at the relationship between these things. And as we talk about Fed funds rate rising, are we talking about a slowdown in demand? Are we talking about softening of demand, which has really been the star when it comes to overall farm income, at least in part, a big part of this. So that's all I got, and we've got a bunch of really great experts to correct all the rest of the things that I've said. All right?
What a great way to kick us off. So please have a seat. Take your pick. Take your pick here. Next up, we've got Erin Borror joining us. She's the Vice President for Economic Analysis for the U.S. Meat Export Federation. Erin joined USMEF in July of 2006 after receiving her master's in Ag Econ at Texas A&M University, making Joe Outlaw incredibly proud, I'm sure. And she received her bachelor's at Cal Poly. As an economist, Erin's responsible for USMEF's red meat export forecasts, trade policy-related analysis, global market analysis, and also U.S. market analysis for international customers. So please welcome Erin Borror to the stage.
All right. Am I on? Yeah, so I should start out with thanks and gig 'em, so I don't forget. And since Seth left us the scraps, I'll just chime in here with a few remarks. Jeff Simmons also covered this really well on the demand story, and that has definitely been the case for U.S. red meat exports. Exports of beef and pork combined last year set a new record of $18.7 billion, and that was setting us up well for a $20 billion potential mark this year, could come close to that. And beef exports have been going at a pace of $1 billion per month, 6 out of the 7 months that we have data for so far this year. And that really has been demand driven, so buying more at higher prices, and that is the taste, the convenience, the health aspects of red meat that we raise here in the US. And the most fascinating thing to me is that this has been whether they're consuming at home or in restaurants. So we have to remember in many of our markets, especially in Asia, COVID is still having a big impact. And so the fact that they're choosing our product, regardless of where they're eating it, just makes it that much better of a story. And the US is a top exporter of beef and pork in the world. So on a value basis for beef, we're right there neck and neck with Brazil. We're number 2 in volume. And we are second only to the combined European Union 27 member states for pork. And the benefit for our red meat exports, and I think even more so as we look ahead, is our feed grain base, our foundation, our natural resources in this country. And indirect exports of corn and soybeans last year, 2021, were valued at about $5 billion. That's just at market price. And so it's our ability to add value to our feed grains through red meat exports that is the real story. And We can't forget our animal health status. That's a reason why we're a leading exporter. We can't take it for granted. Indonesia has FMD and lumpy skin disease running rampant. That's close to Australia. They're super paranoid, but we can't let our guard down. And of course, African swine fever has been all of the news, and that's part of what has driven the surge in pork trade really in 2020 and 2021, was especially the shortage in China, and their comeback has really shifted volumes over the past year. And that is going to, of course, remain in play, but keeping our premier animal health status is absolutely critical. And also our FTA partnerships. We heard about our Canadian relationship this morning from Erin, and having these trade partners around the world is another key reason why we've seen this export success. And again, we have to be proactive as we look ahead. And also just the consistent, large, high-quality volumes of beef and pork, unique cuts and variety meats that we can provide our customers around the world. That's another reason why we are a top exporter. But as we export, and Erin also discussed this some this morning, we have to have those shipping routes and supply chains functioning well. And so another reason why the success over the past 2 years has been so impressive is because our exporters have gone through basically a nightmare every day on the logistics side. I think it's been underappreciated what they've gone through to get this product to our international customers. And we have lost opportunities, no question. Not only did we maybe not have as much product to sell as we could have, but we just couldn't get it there. So our international staff, especially last year when I would ask them, you know, are you feeling pushback from these high prices? They said, no. The people that we talk to in the business just tell us we can't get everything we want. And so price is probably becoming more important as we look at the economic situation. But really over the past year to 2 years, they just couldn't get everything they wanted, and supply chain logistical limitations were a big part of that. We've also seen some decrease in our chilled business, which is a big comparative advantage for us typically because of our shorter shipping times into the Asian markets. But when your ships don't go on time, that hurts, and when your importer has to freeze down product, it costs them a lot of money. So we've seen retail customers look for more frozen, and that's taken some premiums out. So the logistics situation is critical. And as you can see in the charts, these West Coast ports, 75% of beef waterborne exports are out of West Coast, about 50% of pork. And so the labor contract negotiations that are still ongoing, you know, everyone continues to watch. And as we look around the world, we have markets, you know, in many countries globally. And so just to highlight the diversification of our export markets, and part of the strength in prices globally has been indicative of tight global supplies. And so on the pork side, again, African swine fever has been impacting, especially in Asia, of course, recently in the Dominican Republic and Haiti. So that's been supporting some of our Western Hemisphere growth. The Mexican market has really helped to offset the slowdown into China, but it's been critical to have this diverse export market base. We have strong market share in the Western Hemisphere. We're a bit insulated from the European onslaught. When Europe pulled back their exports to China, they really shifted heavily into especially the Asian markets. And so again, the broad base of our markets is absolutely critical. And that is part of what's going to continue to offer us opportunities as we look ahead. Plus, on the competitor side, Europe's production is down 4%. European Commission forecasts will be down 5% for the year. And for me, this is a watch out on what not to do policy-wise. So Europe not only has ASF constraints, that is a big part of it, but they also have the regulatory burden, and that's what's driving a double-digit decrease in Germany's production. So I see that as an opportunity for us, as the biggest global exporter is having the first meaningful decline in production in recent history. Top exporter pork production this year will be down for the first time, at least meaningfully down for the first time since 2009. And for the US beef export markets, again, really diversified, strong growth. Broad-based strong growth has been so impressive. So yes, we had China come in after the phase one and jump up to a $1.6 billion market from basically nothing. And so the phase one has been critical, but what that did was introduce another bidder into the global marketplace for US beef, forcing Japan, Korea, Taiwan, all of the other markets to pay more for short plate, for example. And so that's been the power of China, has been driving value from all of our markets, forcing them to pay more. And it helps that China, everyone's afraid will they be able to get what they need when they know China is in there buying. And so again, the value story on the beef side, our exports just per head for fed slaughter so far this year have been averaging $476 per head. $49 of that is the variety meats. So your tripe, intestines, tongues, everything that we don't consume so much here in the US. And on pork, we were averaging $59 per head for every head slaughtered was exports, and $9.52 of that was variety meats on the pig side. And so just to me, the value of exports is all about maximizing the value of every animal we produce. And as we are in this high cost environment, as Seth was pointing out, we have to have these diversified export markets. And then when we look at the economic situation that we're facing globally, we know the strong dollar is a huge headwind, but these economic impacts really vary depending on the market. So for example, the Mexican peso has been holding quite steady at around 20, while we've had historic devaluations in the Japanese yen, the Korean won, and the Chinese yuan is actually back to above 7 again as well. But then you have the Mexican peso holding quite steady. So to me, the energy situation, all of this impacts everyone differently. The Middle East benefiting from the high energy prices and tourism coming back. So we just need to have access to all of these customers around the world so that we can penetrate the ones willing and able to spend the most on our products. And not to forget that you and I probably don't eat that much, liver or tongue or stomachs or feet. And so having these customers, every pound that we're able to sell of these variety meats adds dollars across the whole supply chain. And so USMEF's international staff, our boots on the ground are out there working this market every day and helping to educate the customers of our exporters on how to use U.S. red meat and products profitably. And that is more important than ever as everyone's facing high costs, limited labor. Jessica, who works for me, was in Malaysia last week. She said they have worker shortages as well. We hear it from China, we hear it even from Latin America. And so making sure they can use our product affordably and educating on the convenience. And finally, we do this in partnership with many of you in this room. Special shout out to our Kansas and Missouri partners on the checkoff side and commodity organizations, and of course to USDA, who we work hand in hand with, and especially their staff on the ground around the world. And I'll end with that, except also to say the OECD projections out today, I just scanned them, but basically all of our big import markets have better outlooks than we do as far as just pure GDP growth. So another reason for exports, and I think that's all for me. So thank you.
Thank you, Erin. Not only is she a beef producer in Northern California, but she really knows her stuff about beef markets. Next up is Nathan Kaufman, who is the Vice President and Omaha Branch Executive with the Federal Reserve Bank of Kansas City. He's also the Kansas City Fed's principal expert on the agricultural economy, and we're so grateful to have him join us here today. He leads several bank and Federal Reserve System efforts to track the economic and financial conditions of U.S. agriculture, and he also hosts the Kansas City Federal Reserve's Agricultural Symposium. Nate joined the Federal Reserve in 2012, and he received his PhD from Iowa State University as well. So welcome, Nate Kaufman.
Well, good afternoon, and thank you for that kind introduction and the invitation to be here today. As was mentioned am I on here? Can people hear me okay? Do I need to push? Oh, there we go. Okay. Well, good afternoon again. As was mentioned in the introduction, I am with the Federal Reserve Bank of Kansas City, so it's great to be able to be here when our office is really just a couple miles down the street. Appreciate the chance to join. It's been a great program so far, and appreciated the comments from the other panelists so far. Let me just very briefly describe why we focus on agriculture at the Kansas City Fed for people that might not be familiar, and I'll try to offer my goal here this afternoon as quickly as I can is to offer a view of what we see with respect to economic and financial conditions in agriculture and some of the risks. So it probably goes without saying, we at the Kansas City Fed here cover 7 states in the middle of the country. This is a region, as most of you probably know, it's highly concentrated in agriculture. We have a lot of banks that lend into agriculture, so it's something that we follow quite regularly. So that's part of our job as a regional reserve bank, is to track conditions here. With that in mind, then, part of my role at the Fed is specifically to lead our efforts with respect to agricultural research and outreach. So I want to get into it very quickly. I'm going to describe kind of, again, high level what we see with respect to conditions, and I'll end with a few risks, because that's what we have to do, is point to where things are, but then also some of the risks. I want to start by saying first, at a high level, economic conditions in agriculture are remarkably strong. And I want to start here because this is not something that I would have said probably 2.5 years ago. And I think it is an important place to start just because of how significantly different conditions are today relative to what we might have said back then. As some context, prior to the pandemic, we might have been saying things like, the ag economy is facing sort of a prolonged period of gradual increases in financial stress. Commodity prices had been low. That had been ongoing for some time. Trade was an important discussion. We were worried about what those trade disruptions might have looked like, and it was generally an environment that was leading to more financial stress. That was before the pandemic. We could spend the rest of the afternoon talking about what happened during the pandemic, but I'm not going to do that. I'm going to fast forward and simply say, as Seth pointed out very well in his opening remarks here, that incomes are incredibly high. We've seen commodity prices pick up. Yes, there are very high input costs that are leading to some concerns, but generally speaking, economic conditions in agriculture, with some caveats, are quite strong. Land values, for example, are about 25 to 30% higher than what we might have seen before the pandemic. And again, that was a time that land values had been declining. The first couple months of the pandemic, it was maybe thought that we would see further declines, but here we are a couple of years later and seeing that, in fact, conditions are much stronger. Prior to the pandemic, we worried about gradual increases in loan defaults. We looked at bankruptcy rates. We looked at other things that we thought there was going to be more financial stress and not less going forward. And the reality is that loan delinquencies are at one of their all-time lows. Working capital levels are very high. Producers are generally in a strong position. And so we're seeing, again, from a financial picture, things are rather strong there too. So I know I'm not going very far into any details, and that's deliberate. We want to just spend a few minutes to seed the conversation. We look forward to the questions that people have, and obviously not being able to touch everything. But I want to wrap up with my comments here just as on the panel, and then look forward to join my other colleagues here, describing some of the risks. Because we definitely see conditions both last year and this year much stronger than what might have been anticipated both before the pandemic and in the first few months of the pandemic. But we are starting to see some of these risks materialize and become worth describing a bit more. And again, Seth did a fantastic job of laying some of these out, and I want to go just a little bit further for a minute into some of these, because many of these risks, I think, are revolved around a pretty similar theme, and that is some of the growing macroeconomic headwinds that we see in the foreseeable future in the coming year. The first of them, I'll talk about three. The first of those is economic growth, broadly speaking. When we talk to businesses of all sorts, not just in agriculture, but across the board in our region last year in 2021, most would have said that 2021 was a record year. They were seeing new orders for various shipments and purchases and investments that were unparalleled in decades prior. And so growth as it relates to broad measures of activity in 2021 was incredibly strong. In the United States, it was somewhere on the order of 6%. Keep in mind that we hadn't hit that level for a very long time, and the average rate of growth in the 10-year expansion that we saw after the financial crisis was roughly 2%. So 6% growth in 2021. In 2022, that number is expected to be it's less than 1% right now in terms of what's expected, and there are concerns about economic growth in 2023. I'm speaking, of course, specifically with respect to the United States. I could expand that conversation to have that be more on a global level as well, that we're seeing reductions in expectations for economic growth. So that's the first one. The second one is inflationary pressure. And again, Seth mentioned this one. For those 10 years that we spent in the longest economic expansion on record after the financial crisis, inflation was generally less than 2%. And the Federal Reserve, as many of you may know, has a goal for inflation at 2%. We're at 8%. That's higher than 2%. So there are concerns about what inflationary pressures might do with respect to some of the costs that have been mentioned. I know when inflation is a problem. I have a couple kids that sell eggs out of our backyard, small backyard chicken flock, and we sell to friends and neighbors, and she had a customer that came to the door a couple months ago and actually preemptively offered to pay more because of inflation. And I thought that's what I definitely know that inflation is real, is when your customers are offering to pay more without being asked. Unfortunately, my daughter said, no, we're good. There's no inflation to worry about. So inflation is the second one. The last one that I'll mention then is interest rates. At the end of 2020, if you were to look at some of the projections that Federal Reserve officials would have suggested would be appropriate interest rate policy for 2022, many would have indicated that rates were likely to still be approximately zero by the end of this year. Instead, we're in a different environment, and this is in large part because of inflation, where we're now seeing interest rates closer to 4 to 4.5% by the end of this year. So all of these macroeconomic trends that we're observing the last few months, I think will be significant as we look at broad forces that will shape agriculture. It will have effects potentially on things like exports. It could have broader effects as it relates to the possibilities for producers to earn off-farm income. And so there are definitely risks. So again, I want to close my comments here, and I'll look forward to questions simply by saying that for right now, conditions look very strong. Many producers are in a good financial position this year. Leverage is quite low, and generally most loans are being repaid on time and in full. Most lenders would indicate there's very limited signs of financial stress. But it's not to suggest that there aren't risks. I think there are some possibilities that we see limited profit margins next year, and again, with some of these macroeconomic headwinds, those are some of the things that we're watching for. So with that, I'm going to wrap up my comments. I look forward to the questions, and thank you again for the invitation.
Thanks, Nathan, for pointing out all those different points. That we'll have a very robust discussion with our full panel. But last but not least, our next panelist is Galia Barr, who is the Director of Corporate Economics at John Deere. In her current role, she manages a team of economists overseeing all facets of economic analysis in both the farm equipment and construction fundamentals. She's looking at both short and long-range industry factors, and we're really pleased to have her join us today to discuss the perspective from Deere and the equipment industry in general. She also joined Deere about a decade ago, and prior to that, she had several different jobs in multiple financial organizations. She's also an Iowa Stater, and so we're pleased. I didn't plan that, honestly, to have so many, but it's pretty good. Thank you, Galia.
Thank you, Sara. Thank you for the kind introduction. Thank you, Sara. And go Cyclones here. I count 3 of us up here. So my name is Galia Barr, and as Seth said, it's great to be the beginning, and it's also great to be in the end, because our expert panels here already touches on a point that what's happening in the global ag economy and also in the US as well. So what I thought I'll do today is kind of talk a little bit more on give us some updates on the supply chain and what do we expect and how these could play out over the next few 18 or 12 months here. So if you remember back on the onset of the COVID-19, when we all stuck at home and didn't know what to do with ourselves, many of us couldn't go to the trip that we planned for, and therefore what did we do? We shifted those money into spending from services into goods. And therefore, we have seen this astronomical, it's quite a large change of demand in the US. And on top of that, we saw the government stimulus money added about $6 trillion into the US economy. So therefore, it wasn't surprising that we see this large demand coming in. Now, on the supply side, we saw this quite a bit of imbalance here. And Monica this morning talked about the labor market in specific, that we have still seen a lot of people sitting on the sideline. About 3 million workers that left the workplace during the COVID hasn't come back yet. And right now, there are about probably 2 jobs for every 1 person who's looking for a job right now in the market. So definitely that market has been tight and will likely continue to be tight over the next few months here. But that, depending on what our panelist is talking about, is when the economic slowdown happens, we're likely to see some of these happening, easing in the labor market as we move into the rest of this year and also next year. Now, on the supply chain side, yes, it feels like we are still in the middle of recovery. This is the supply chain pressure index that the New York Fed put out. Basically, they're looking at the shipping container cost. They also look at the bulk container cost, the back order delivery time, and things like that. Yes, we have seen some of those index pressure peaked at right about the end of last year, where we saw the Omicron virus outbreak, and things has been improving since then. But don't get me wrong here, things are improving, but it's not back to where we were yet. And right now, if you look at the freight costs, we have seen about 60% decline in freight from China to the west coast of the US. So things are moving into that direction that we are seeing some of those easing in the supply chain. However, the balance, the improving that we see, you start to see some of the retailers or the big box company talking about they might have more inventory. They may perhaps what they ordered 6 months ago finally arrived, those winter jackets finally arrived in the fall. So those were just not the right inventory at the right time. If you look at from the retail trade standpoint, the inventory is kind of creeping back up here. But if you think about manufacturing, things are still looking a little tight here. If you are shipping this vehicle or these machineries that has thousands of parts and they're missing a few parts, you can't ship them. And that's why you look at the manufacturing, we still see quite a bit of inventory that is built up. In fact, if you look at the auto industry, Ford is saying that in their Q3 earnings, they might even have 40 to 45,000 vehicles that are missing parts that they can't ship out quite yet. So that continues to be what is happening in the supply chain. But as Nate mentioned here, we expect to see some slowdown in the economy because of the inflation is high and the Fed is raising the interest rate. So by design, we're likely going to see some of this economic slowdown that would help providing some room for the supply chain to recover. I would say there were probably a couple of things here I would keep an eye on as we move into the rest of this year and also into next year on the supply chain side. The first one is looking at the situation in China on the zero COVID policy. Because if we continue to see this kind of strict policy going forward, whenever there's an outbreak on COVID virus, we would continue to see this disruption, pocket of disruption continue to happen. So definitely looking at that. And second is keeping an eye on the energy situation out in Europe, because if we have that market is quite tight. So if we have extreme cold or extreme weather in Europe, that could potentially have some impact on the supply chain going forward as well. So with that, I appreciate your time today and thank you for the invitation, Sarah. Looking forward to the discussion. Thank you.
Well, thanks to all of you, and I bet we're going to have a lot of questions come in a rather short amount of time. So get your Slido app out, and you can start sending those in. And I'm going to start with a couple of things that you said at the start, Seth, when you were talking about next 18 to 24 months in the cattle cycle, and Erin, you can jump into looking at what are those factors that you're going to be paying the closest attention to see where we're headed, and then on processing capacity, because I know a lot of folks in Missouri are excited about a brand new plant coming in here. There's some others that are coming online. So just share, what are the critical things that you are looking at?
I'm almost embarrassed sitting next to an expert on this, but I'll give you my thought. I'm going to go first.
Yeah, no.
I want you both to comment.
No, and we talked about this. And so I think we've gone through, again, correct me, we've gone through several years where we peaked on cattle numbers in the 70s and it's come down. And part of what we've seen is the industry capacity shrink and shrink and shrink. But then the last 5 years we hit this balance where we're actually tight capacity. And my sense is that there is at least a lot of chatter that the industry capacity is going to expand. At the same time, when one looks at heifer retention and heifer slaughter and kind of the direction we're heading in the cattle cycle, we're heading in the opposite direction of having fewer animal numbers. So my 12 to 18 to 24 months is that at some point out there in the next 2 years, we're going to invert, and you're going to have packers looking for cattle. That's my point.
Yeah, totally agree. Yeah, I think, I mean, you're starting to see it in the market, or we have been seeing it in the market, already. And so, again, just looking at it from the export perspective, a few things. I see the critical need to add value to every animal to get that value across the supply chain. So the tables do turn in favor of cow-calf. They have been the ones, getting the lesser share for the past several years as expansion was underway on the live cattle side. So now those tables start to turn back to their favor, but then making sure that we get every dollar on the beef side so that the packer can indeed pay that higher cattle price. So in my mind, on the trade side, that's where exports are so critical, again, to make sure that value is passed back across the chain, and importantly, to send that signal that yes, we do want you to rebuild, right? So we need the rain. That's always, and when I'm in front of international customers, they hate this part in our cycle because they've got their beef case full of US beef and they're like, what? You're telling me you're praying for rain? Like, what am I gonna sell? So it's kind of devastating to me that we have these cycles, because once you build up that really strong demand, you want the product there. But again, we have to continue to maximize the value of every animal. Exports are a key part of that, so that we can send that strong expansionary signal back down the line, so that as soon as we have the pasture, the hay, that base, that we can strongly rebuild.
A lot of different concerns. Galia, you talked about the fact that manufacturing is starting to improve, but there's still crucial parts that are missing. I talked to a large grower at the Farm Progress Show who was telling me that he bought 2 large horsepower tractors right before the pandemic, and so glad he did, because then he could use his older ones for parts. He can't even get parts for anything. One of our questioners wants to know, when will Deere be back up to getting the pipeline running according to pre-pandemic levels? And is it just 1 or 2 parts? Like, is it the chips that are missing, or is it all sorts of things?
This is like whack-a-mole. You got these parts here, the next part is missing. So our employees are working so hard along with our dealers as well, trying to help working through this. We have charter company planes or planes to go and pick up parts in different parts of the world. We charter a vessel to go and do that. So things continue to be difficult, but as you know, we have quite a bit of machines that's sitting for a few parts. So that once we can get these parts coming in, I think that situation would continue to improve. And as we think about the economy continue to deteriorating over the next the outlooks is looking like we're going to see some of those slowing down in demand over the next 12 or 18 months here. So I think that would also help improving. As to when exactly, I can't give the exact time, but I would think that with the macro is softening, we would continue to see that improvement in our availabilities.
So I'm going to throw this out to anyone who wants to grab it. Someone wants to know, if you've got your crystal ball out there, should you go ahead and make investments in new equipment or capital, any kind of things that you might be building associated with the farm or processing in 2023, or is it best just to hold off?
I'll take a stab at providing a general response to that question. So, I do think that there are risks, and I pointed at some of those, especially with respect to when you think about inflation and making investments in projects that you don't necessarily know how things are going to play out in the next 6 to 12 months. We've seen that from a lot of businesses the past 2 years, describing their anxiety of making some of those decisions. What I will say, though, is I think that there's still a narrative that suggests that there are places to invest where in the near to medium term for agriculture are still quite strong. And we haven't spent a lot of time talking about geopolitics, but I think that's one of them. One of the trends that we've seen in the past when it comes to uncertainty and how businesses make investments and how the markets generally perceive risk is that when there is global risk, there's a tendency to look to the United States as a source of stability. And so I think that you've seen part of that over the past couple of years when there has been more uncertainty with respect to Ukraine, but you can see it in other places as well.
Okay, I think we cut it out just a little bit at the end, but you were saying when there's a global uncertainty that people tend to look at the United States as a safe haven for those investments. And just to, looking at the kind of trying to crystal ball here a little bit, Do we assume the war in Ukraine is continuing to be a factor for one more year, multiple years? Does anybody even have an answer to that kind of a question?
That sounds like your forecast.
Well, no, and it's actually, interestingly, this is a source of discussion for us because we do our 10-year baseline. Well, what do you assume? Do you want to call the date that this is all, that regional peace breaks out? That seems to be a very tricky proposition, and as a matter of fact, we seem to be moving in the opposite direction from that in the near term. So I don't see the end of the. I don't know where the end date of this is. And again, part of my point in my presentation was Ukrainian producers are going to have to make some adjustment to rationalize their production for what they can consume and move. And right now, they can't move everything that they're producing.
What about just inflation in general and your baseline assumptions? And for, I'm sure in the equipment industry too, you've got to think, is 8% the high? Are we going to go to 10? Or, are these interest rate moves going to bring inflation down to a level that's a little bit more manageable? Nate?
We hope that 8% is the high, yes. So there have definitely been a lot of challenges with respect to inflation, many of those that were perhaps not anticipated. It goes to some of the points that were made about the supply chain disruptions. We hear a lot about labor shortages. Despite some of the potential for slowdown, many businesses are still pointing to problems connected to labor as being one of the primary aspects of inflationary pressure. As I mentioned, though, we have a goal for inflation, and I think that you will see a lot of focus at the Federal Reserve on bringing down inflation, but recognizing that there may be a cost to doing that.
And Erin, as we look at food price inflation, do we start to see some trade-offs where people will move away from beef to lower priced protein, to more chicken? At what point do you start to see any really market shifts because of these higher prices?
Yeah, it does definitely vary by market. And I know, like Dr. Glenn Tonser's in here, he has data here in the US that gives him good indications of what's happening here. But in the international markets, it really does depend on the market. So we have to remember in a lot of cases, especially in these Asian markets, their domestic product is much higher priced than imported. So yes, we have the strong dollar disadvantage, and that offsets some of our generally pricing advantage. But we're still typically, again, especially in the Asian markets, a relatively affordable beef, for example, and pork compared to domestic. So there's that aspect. There can be some trading around, but so far there hasn't really been a cheap protein. So the high chicken prices have certainly been part of the reason we've seen such a strong growth in our exports of pork to Mexico. And so not having the turkey to ship, we know that pork or hams go into that processed product as does turkey in Mexico. So to me, it really does depend on the market, and yeah, what is that cheaper protein? It's not super straightforward right now. They can trade down in the wider protein category, but at this point, it's a bit mixed. Yeah, there's no clear across-the-board example. In Japan, we have seen them asking for cheaper pork products. They usually price up to meet what they have a gate price, so kind of a complicated system. But so they're looking for a cheaper pork product. But that's a unique situation, and I don't really see shifting within the categories. That's already kind of happened because of COVID's impact on food service. So it's complicated. That's the short answer.
No easy answers. Seth, back to you for a second. You mentioned renewable diesel, and earlier this year we heard from some folks in the food industry that were very reminiscent of the food versus fuel debate. And a lot of their concern was around renewable diesel and the growth there, as well as sustainable aviation fuels, which is, can be produced from other feedstocks as well. But how concerned should some of these food ingredient companies be, the snack food peoples, the Oil and Dressing Association also was part of this coalition that reached out, which I didn't know there was one, but now there is. So how concerned should these groups be about the consumption of renewable diesel and other of these feedstocks?
So I think the height of that concern was when we had announcements of huge volumes of renewable diesel capacity going in, and we had a bigger constraint on the difference between unrefined and refined, say, soybean oil. So I think that at that point they were very concerned about, hey, is this going to continue? We've got renewable diesel capacity expanding rapidly, and we've got this constraint on refining capacity. I think as you look forward a little bit more, we've seen that refining capacity constraint narrow. It's still there. We've continued to see good crush demand in the U.S. And oil carrying a little bit higher share, but also that means relatively cheaper meal as well too, and some incentive to continue to crush and process soybeans. So I think it's fair to say that when the bakers come to visit, the most critical ingredient for the bakery product is the one that you don't have, or the one that's very expensive. So they're dealing with several of these issues, including supply chains. But I really think that as we've seen some movement here with oil prices rationalizing a little bit, meal prices offsetting some in the feed market. And those folks, there is a lot of investment that has gone into that biofuel production as well. But we've got to balance that. We've got to balance those investments, how it supports ag, what the feed value is, and meeting our greenhouse gas emissions goals all at the same time. So we do have to watch it, but I think that a lot of that anxiety was that first element of capacity is going to explode, and it hasn't quite met that.
Nate, you talked about farm debt a little bit in your comments, and as we see interest rates increase now, as you mentioned, we're in pretty good shape relative to some of the things that we've seen in the past, at least. But what are you factoring in and keeping a close eye on as you start to look at the Fed saying they're committed to bringing inflation back down to the 2s and from the 8s? How far will interest rates potentially have to go up? And then what does the outlook look for some of your customers?
So what I would say to that again is going back to what I mentioned earlier about the strength of finances. I think that producers really are in a very good position. What we had been hearing with respect to new debt or even renewal of existing credit lines in 2020 and 2021 was that a lot of farmers were not needing resources financially that they had been prior. And so a lot of lenders, even though they were in a position to want to be able to make some of those loans, the demand just wasn't there. We are starting to see some of that pick up. Some of that is the inflation that we're talking about of increased financial needs. Some of it may be just recognizing that there's more need for investment and expansion and production, some of the other aspects there. I do think that higher interest rates will be a headwind, but I think that, and I won't go so far as to suggest what my personal opinion is on where rates would be headed. That's a different conversation. But what I would say is just simply that that will be some additional pressure. But I don't think that so far it's the primary thing that we're worried about, recognizing the strength that we've seen the last couple of years.
And we're just about out of time and need to head on, but Galia, just one more question for you about Deere looking ahead at production capacity. I know a lot of production in Iowa and then all around the country, but increasingly more in Mexico and in other parts. Do you see that you're better able to source outside of the U.S. now versus within the U.S. because of some of these manufacturing constraints? Or give us kind of an update on sourcing your basic.
Yeah, that's a great question. And as we talked about, the labor availability continues to be a problem. I think that part of that, especially when we still have a big operations in North America, we still have a big operations in Iowa, but increasingly we also realize that having rural operations becoming more difficult for us in terms of labor availability. So those are kind of things that we are thinking days in and days out, but definitely to be able to deliver products to our customers in the right time at the right place. So that's continued to be our key that drive our decisions.
Thank you. Well, lots more questions have been coming in, but I hope that you can stay for a little bit during our break and that we'll have a chance to ask you some additional questions. But please join me in thanking our panel, all the contributors.